What's up, millennials? Today I'm going to do something very special. What I'm going to do today is I am going to show you my exact method that I use to value SPACs. And I'm going to show you that method from A to Z all the way. Now, this might be actually a quite long video, so I'm going to add chapters to this video so you can actually skip to the correct moments, the parts that you want to listen to. But of course, you can just watch the entire video as well. It took me quite a long time to make this video, so please consider sharing this video as well with your friends who might be investing in SPACs as well and who might actually be able to use this information in a good way as well. In this video, I'm going to be talking about two different methods, or actually methods that look pretty much the same, but there are some slight differences. Method 1 has 7 steps and method 2 has 6 steps. And some of these steps are even overlapping, so these are similar steps in both methods. And when I'm done explaining these two methods, I'm actually going to give you a few additional comments that I believe are very important if you're looking at valuations of SPACs, and also comments about SPACs in general. The first 3 steps that I'm going to talk about right now are steps that are useful for both methods, all right? And the very first step is to join the Discord and get the Excel sheet, which is going to help you quite a bit on your way to value a SPAC. So how do you get that spreadsheet exactly? Well, first of all, you go to nesami.com/discord. When you go there, you can leave your name and leave your email address over here. You click submit, and then you're going to be able to get access to the Discord channel. Now, once you're inside the Discord channel, you're going to find this channel over here that says SPACs. And then you can actually go to the pinned comments, or the pinned messages as they call it. And then you're going to find this link over here that says something along the lines of, this is a sheet that I use to calculate, or that I use to calculate these SPAC evaluations, right? So you click on that, and then you're going to be brought to a page, a Google Docs page that looks like this. And then you're going to be able to make a copy for your own so that you can actually use this sheet as well. And I'm just going to briefly go over this sheet as well with you. So as you can see, there are some colored cells in this one, some yellow cells. These are the cells that you need to change for the SPAC evaluation. During the next steps, I'm going to be talking about basically all of these cells, all of these like enterprise value, market cap, amount of outstanding shares, etc. So that is going to happen in the next steps. But for now, I'm just going to tell you that you would need to pay attention to these yellow cells. You're going to need to pay attention to those, and you need to fill in those cells. Step 2 is going to be to determine the pro forma equity value. Pro forma equity value. What does that mean? Well, first of all, what does equity value mean? Equity value basically means the same thing as a market cap. You might know the word market cap. This is the amount of outstanding shares multiplied by the price per share. Okay, so let's say, for example, you have a company that has 100 million outstanding shares. Okay, if one share is $10, so $10 per share, that means that you can now multiply the amount of outstanding shares, 100 million, by $10 per share. And that means that you're going to have a market cap of 1 billion, right? 100 million multiplied by 10, 1 billion. So the market cap would be $1 billion. The market cap or the equity value, again, those are the same word. So the equity value is as well $1 billion. But what does that pro forma mean exactly? Well, the thing is, the SPAC, in this case, for example, I'm using the example of Switchback Energy, which is the SPAC that's going to acquire ChargePoint. The SPAC is not going to entirely own the company they're going to merge with. Switchback Energy is not going to entirely own ChargePoint after the merger. It's usually like 10 to 20% more or less, maybe even 25% of the company. In Switchback Energy's case, we can see that it's a little bit small maybe, but here you can see that Switchback Energy investors are going to own 10.3% of the entire deal. So the SPAC gets more or less 10% of the entire deal. The thing is, the SPAC has, as we can see in this investor presentation as well, SBE investors have 31.4 million shares, okay? So now you might say, okay, 31.4 million shares multiplied by a base share price of $10 per share, because Switchback Energy started trading at $10 per share, means a market cap, a pro forma market cap of $314 million, right? That's not the case. That's not the case because, again, Switchback Energy is just going to own a part of ChargePoint, okay? Some people say, well, ChargePoint is going to be 314 million. No, just a SPAC, 314 million. So pro forma, again, what does that mean? Pro forma means all the shares after the merger has been completed, all the outstanding shares after the merger has been completed, not just the shares from the SPAC, but also from all the other shareholders around the company. In this case, we can see ChargePoint shareholders, so shares of ChargePoint, the company that is going to be acquired by the SPAC. And then SBE investors, so investors that are investing in the SPAC. PIPE investors, which are like private investors, people with a lot of money that actually want to put money in this company as well. And then founder shares, these are shares of the SPAC founders. So all in all, there are way more outstanding shares than you might think. And again, pro forma means the combination of all of these shares together as if it were already a company that had merged. So again, you don't just look at the 31.4 million shares, but instead you look at the total amount of outstanding shares after the merger, which in this case, if you add all of these shares up, you're going to arrive at an amount of outstanding shares of $304.9 million. That is the number that you can work with. So that is the number of outstanding shares that you can multiply by $10, right? So you take that amount of outstanding shares, you multiply it by 10, and then you're going to arrive at your pro forma equity value, or again, your pro forma market cap. And in this case, that is of course going to be $3.049 billion, which is also the number that we can see over here in the investor presentation right next to equity value. However, the thing is, right now, Switchback Energy, SBE, is not trading at $10 anymore. If we go into TradingView, we can see that they're currently trading at $36.11. First of all, before I go on with that, you can, if you use the sheet from Discord, you can here put the share price where they started with, so $10. Here you can put the amount of outstanding shares, so the total amount of outstanding shares. And here you can put the amount of net cash. We're going to talk about that a little bit later on as well, okay? So we said Switchback Energy is trading at $36.11. That is the number you can put over here in the Excel sheet under the column now. So 36.11. Okay, let's go back here. That means that the price has gone up from $10 to $36.11. That also means that our pro forma equity value, or our pro forma market cap, has also gone up from, first of all, it was $3.049 billion, but now it is sitting at $11 billion. So that's quite a big difference, of course. So again, keep that in mind. The most important part, look at all these shares that are outstanding. Are you still with me? Okay, I hope so, because now we're going to go to step number 3, which is to determine the pro forma enterprise value. Slightly different from the equity value, okay? Enterprise value, what does that mean? Enterprise refers to the company. So the value of the company, the value of, in this case, ChargePoint, which is the company that is going to be acquired by the SPAC. Why is there a difference between the enterprise value on the one hand and the equity value on the other hand? Well, the thing is, the equity value consists of two things. It consists of the enterprise value and the amount of cash they're going to have on their balance sheet. If we look at the investor presentation, again, we can see that the equity value based on a share price of $10 per share was $3.049 billion. But the enterprise value is lower because it's $2.401 billion. Why is there a difference? Well, again, that is because of the amount of net cash they're going to have on their balance sheet. The SPAC is going to give them a certain amount of money. ChargePoint already has a certain amount of money as well. And in total, after the merger has been completed, we're going to see that ChargePoint is going to have $648 million in cash on their balance sheet. So we can now say, okay, we have an equity value based on $10 per share. It's $3 billion, more or less. We have the amount of net cash, 648 million. If we take that equity value, subtract the amount of net cash, then you're going to arrive at an enterprise value. So again, 3 billion or 3.049 billion minus 648 million gives you an enterprise value of 2.401 billion. But again, we said, okay, the price has now gone up from $10 to $36.11. So the equity value has gone up to $11 billion. But of course, the net amount of cash has not changed. That is going to remain the same, 648 million. And by the way, that is the number you're going to put in here in this yellow cell over here. So 11 million minus 648, sorry, 11 billion rather, minus 648 million. That is going to give you a pro forma enterprise value of $10.361 billion. So in conclusion, ChargePoint, based on a share price of $36.11, is worth right now, pro forma, again, after the merger, $10.361 billion. Okay, those are the basic steps for both methods, but now we're going to go a little bit more specific into both of these methods that I'm going to talk about today. The first method that we're going to talk about is the so-called discounted future enterprise valuation method. And that's a very difficult word, of course. Discounted future enterprise value method. Okay. Again, I said two methods. Why are there two methods, first of all? Well, method one, the one that we're now going to talk about, is mostly used for companies that don't have a lot of revenue right now. But they do expect to grow quite a lot in the next 5 years. So you could say, okay, with the numbers you have right now, the company is not going to be worth a lot. But if you look at the future, well, you're going to have lots of revenue, so the company is also going to be worth way more than it is right now. Method two, as we're going to see later on in this video, is more for companies that already have a pretty solid business model. They've already pretty got a like established business model. They already have quite a lot of revenue, etc., etc. So for method one, we're going to be looking at ChargePoint. For method two, we're going to be looking at PaySafe. Let's now go to step number 4, which is actually the first step of this first method that we're going to talk about. So step number 4 is to determine the future enterprise value. We now already know what an enterprise value is, but now we're going to take a look at how we can calculate the future enterprise value. For this, we need two numbers. We need, first of all, either a revenue number or an EBITDA number, okay? Revenue number is pretty obvious, I suppose, because that's simply how much money a company makes or expects to make in the future. EBITDA is a financial measurement that stands for earnings before interest, taxes, depreciation, and amortization. This is an important measurement of the financial performance of a company, you could say. If you want to read more a little bit about that, then I would suggest that you go to the sources that I'm going to put in the description so you can learn a little bit more about EBITDA if you don't know about that already. Okay, so the first number you're going to need is either revenue or EBITDA. The second number you're going to need is a revenue or an EBITDA multiple. In a second, I'm going to explain what that means exactly. And we're going to use ChargePoint or Switchback Energy as an example. Okay, first of all, the first number, revenue or EBITDA. In the example we're going to use today, we're going to look at ChargePoint. We are going to take a look at their revenue. Okay, you can also take a look at the EBITDA, but in this case, we're going to take a look at the revenue. In method 2, we're actually going to take a look at PaySafe's EBITDA instead of revenue. Okay. So if you look at the long-term financial summary of ChargePoint, we can see the following. We see that in calendar year 2020, they expect, or they had actually, $135 million in revenue. Now again, if you remember, we just said that that the enterprise value of ChargePoint was more or less $10 billion. A company with $10 billion and only $135 million in revenue, well, that doesn't really add up, because that would not mean a lot of revenue for a company which is relatively big. Well, the thing is, ChargePoint, the valuation of ChargePoint is not based on their current revenue, but on their future revenue. Okay? Let's take a look at what happens in future years, or what they expect to happen in future years. And of course, the word expect is a very important word over there. If we look at the revenue from 2026, which is the last year they have predictions for, we can see that they expect to have a revenue of $2.069 billion. So that already makes a little bit more sense if you now look at the enterprise value of ChargePoint and the revenue. $2.069 billion. Let's actually put that in our calculator. Let's see if we got enough zeros. That should be it. So we now have our revenue. And as I said before, we now also need a revenue multiple. Well, for that, we're going to go to a different page, which is going to be this page over here, which says valuation benchmarking. This is a very important page if you want to value SPACs. What they do here is they compare themselves with other companies out there, and they basically look at their own metrics, their own revenue multiples, for example, and they compare those multiples to other companies, similar companies out there. We are going to take a look at this metric over here, which is the EV to revenue multiple, so the enterprise value to revenue multiple. What does that mean exactly? Well, let's say, for example, and let's not talk about ChargePoint for a second. Let's say there is a company that has $100 million in revenue, and the enterprise value is $1 billion. What that means is you have an enterprise value to revenue ratio, or what they call an EV to sales ratio, of 10. Because companies has 100 million in revenue, enterprise value is 1 billion. 1 billion divided by 100 million is 10. Okay, so the EV to sales ratio, or enterprise value to revenue ratio, is 10. Okay. Now, as we can see, ChargePoint says that they're going to have an EV to revenue multiple of 1.2 in 2026. 1.2 in 2026. If we go a little bit to the right, and let's actually zoom out a little bit so you can see all the companies, you can see that they have compared themselves with other companies out there. Tesla, Peloton, Alarm.com, Enphase, and SolarEdge. And they've taken a look at their EV to sales ratios, or their enterprise value to revenue ratios. Tesla, 10.5x, Peloton, 7.9x, Alarm.com, 5.0x, Enphase, 11.8x, and SolarEdge, 8.0x. Yes. What they usually do with SPACs is they look at the so-called median multiple. The median multiple is simply the number in the middle. So if you would put these 5 numbers from low to high, you would start with Alarm.com, then you would go Peloton, then SolarEdge, then Tesla, then Enphase. The middle, the third number of those 5, would be SolarEdge, with a multiple of 8.0x. Sorry. So that is the median multiple, 8.0x. Very important. Now do notice, and this is also very important, that these multiples are for 2021. But ChargePoint says we're looking at 2026. So there's a discrepancy here. And that's why we need to go to a discounted enterprise valuation method in the next step, but don't worry about that just now. That's what we're going to do in the next step. Okay, so the median multiple is 8.0x. Very well. Let's go to another page. This page over here. Here they say, well, okay, so the median multiple is 8x. Very well. We are going to give, instead of using a number, instead of using one number, 8.0x, we're going to use a range of numbers. And they go a little bit on the conservative side to be a little bit more conservative. They say we are going to take a look at a range of multiples from 4x on the low end to 9x on the high end. Okay, 4x on the low end, 9x on the high end. And we are actually going to add one more multiple to that, which is going to be called the midpoint valuation, which basically just is the average of these two multiples. Okay, so in this case, that would be 6.5 because, well, 4 plus 9 divided by 2 is 6.5. Okay, let's do that. We now have our two numbers. First of all, and I just deleted it, but okay, we had a revenue of $2.069 billion, and we now have this range of multiples. 4x on the low end, 9x on the high end. Let's do the calculations, because the only thing we now need to do is simply multiply the numbers. Let's first start with the low multiple of 4x. So $2.069 billion multiplied by 4 is $8.276 billion. That is the low future enterprise valuation for ChargePoint, which is the number in the calculator, the number in the investor presentation, and it's also the number that I just entered in the Excel sheet as well. So that is the low one. Let's now go back to that revenue of 2026 and let's now multiply it by the high multiple, which is 9x, because we just decided that we're going to use a high multiple of 9. So if you take that revenue, multiply it by 9, we're going to arrive at a high enterprise value of 18.621 billion. In the investor presentation, it's slightly different, just a few rounding differences, I suppose, but 18.622 billion, that's fine as well. I believe that's also what I put in my Excel sheet. So I basically copied what they said in their investor presentation and put that number in their Excel sheet. But now exactly you know how they arrive at that number by taking the revenue, multiplying it by 9. Let's go a little bit bigger over here, because we just said we're going to add one more thing, which is going to be called the midpoint enterprise valuation. And that is simply going to be the average of these two numbers we just calculated. So the low one, the high one, just the average between those two. Just add these two up, and you're going to divide them by 2, and then the average is going to be $13.449 billion. Okay? So that is the future enterprise value. And remember, I said either you need to use the revenue or an EBITDA. This example, we used the revenue, but it could also be the EBITDA of a certain year, okay? That's something we're going to do in the next method as well. If you're using the EBITDA, you're going to need to multiply that as well by the EBITDA multiple. That seems fair based on the comparison on the valuation benchmarking with other companies. So that is something you would need to figure out, or that is usually something as well that is in the investor presentation as well. Then step number 5, which is the second step of this first method, might seem a little bit overwhelming, but I hope you're still with me. Step 5 is to determine the discounted enterprise value. We know what an enterprise value is. That is the value of the company that is going to be acquired. So the company is going to be ChargePoint in this example, of course. But we're now going to take a look at the discounted enterprise value. The formula that we're going to use for that is also a formula that is used for the so-called discounted cash flow method, more or less. If you want to read more about the discounted cash flow method, please check out the source in the description. I'm going to put a link there so you can read a little bit more about that. For the discounted enterprise value, we're also going to need two numbers. The first number we're going to need is the number of years we're going to need to discount it back. I'm going to explain that in a second. The second number we're going to need is a discount rate. Also going to explain that in a second. First of all, the number of years to discount it back. It's relatively easy. It's very easy actually. Because we just said in the previous step that we were looking at the revenue of 2026. And we determined that the enterprise value was going to be between 8.26 billion and $18.622 billion. Okay, very well. Now, that was 2026. We want to know what the value is in 2021, which is the year we are living in right now. The number that we need is the number of years to discount it back. So basically that means you can take 2026 and subtract 2021, and that means that we need the number 5. So we need to discount it back 5 years in time. So the number 5 is one of the numbers we are going to be using. The second number we're going to be using is a so-called discount rate. To explain the discount rate, I'm going to give you a simple example, which has nothing to do with ChargePoint. Let's say you have a company, a very big company, because you're doing very well, that is worth $1 billion. $1 billion. And let's say you're going to grow that company 20% each year. My question to you is, how big would your company be in 5 years' time? Well, you would need to take the current worth of your company, 1 billion, multiply it by 1.2 if you are actually growing at 20% per year. So after 1 year, you're going to be at 1.2 billion. After 2 years, you're going to be at 1.44 billion. After 3 years, it's going to be this, 4 years this, 5 years this. So after 5 years, your business has grown to almost $2.5 billion. So you knew that your company was worth 1 billion, and you used this calculation to calculate the future enterprise value. Okay? With the discount rate, we're actually going to go the other way around. Because now, with the example of ChargePoint, we know the future enterprise valuation, but we want to know the current enterprise valuation. Well, in the simple example with the $1 billion company that's growing at 20% each year, what you can do is simply, instead of multiplying it by 1.2, you can divide it by 1.2. So in year 4, it's going to be this, year 3 this, year 2 this, year 1 this, and the current year, again, $1 billion. It's magic. So we can also do exactly that with ChargePoint. We said, again, the future enterprise value is between 8.276 billion and $18.622 billion. Okay. But now, what is a discount rate? What is the clear discount rate? But because in the example we used a discount rate of 20%. Sorry. In the case of ChargePoint, they use a discount rate of 15%. Slight difference. Some SPACs use 20%, some SPACs use 15%. It usually depends a little bit on how quick the company is going to grow. So in this case, we're going to use a discount rate of 15%. Actually, most often 20% is used, but I think Switchback Energy, or at least ChargePoint rather, already has a pretty solid business model, and they grow a little bit less fast compared to other SPACs out there that don't have any revenue just yet, but are going to grow way faster compared to ChargePoint in the next 5 years or so. Okay, let's go to the valuation. So let's first take a look at the low valuation. We said that the company, ChargePoint, is going to have in 2026 a low valuation of $8.276 billion. Well, we also just said we can divide it by 1.15, okay, because of that discount rate of 15% instead of 20, we're going to use 1.15. So that means that in 2026 it's still 8.276 billion. But in year 5, it's going to be this number. In year 3, it's going to be this number. Year 2, year 1, year 0. So the current discounted enterprise value for ChargePoint would be $1 billion more or less, which is the number over here in the calculator, also here in the investor presentation. And if my calculator in the Excel sheet is correct, it also does the exact calculation for you in the Excel sheet as well. Okay, very well. We can also do that with the high valuation. So we said for the high valuation, we calculated a future enterprise valuation of $18.622 billion. We can do exactly the same thing. But instead of, well, just doing 1.15 and then do that 5 times, you can also do it slightly faster, which is first to use parentheses as well, to divide it by 1.15, and you can do that to the power of 5, because you need to discount it back 5 years in time. Parentheses, and that is going to give you a discounted enterprise value of $9.3 billion more or less, which is the number in the calculator, the number in the presentation, investor presentation, and if it's all correct, then we're also going to see this number in the Excel sheet over here in the Discord. So that is the discounted enterprise value for the low end and the high end. And of course, we can also, for this one, calculate a midpoint enterprise value, so a midpoint discounted enterprise value, a lot of words, which in this case, again, is going to be simply the average of these two numbers, of the low and the high number. So that is going to be a discounted midpoint enterprise valuation of $6.686 billion. Then we're ready for step number 6, which is to determine the fair equity value. I hope you remember what the equity value is. The equity value is the market cap. And the fair equity market cap, well, fair here is based on calculations. It's not necessarily fair in the sense that it should be 100% that price and else is going to be a ripoff, okay? It's fair based on the calculations. Fortunately for both of us, this is a relatively easy step compared to the other steps we've just been doing before. For this step, we're first going to take these enterprise valuations, the discounted enterprise valuations that we just calculated in the previous step. The only thing that we need to do is to add back the amount of net cash on their balance sheet after the merger. Because if you might remember, well, we said in the beginning of this video that if you take the market cap, you subtract the amount of net cash, you're going to arrive at an enterprise value. Now we need to do the exact same thing, but now vice versa. We need to go from an enterprise value to a market cap. And you do that by taking these enterprise valuations, adding back the amount of net cash. That is going to give you these fair market caps, these fair equity values for ChargePoint in this example. So if you do that for the low valuation of 4.1 billion net enterprise value plus 648 million in net cash, that is going to give you a fair market cap of $4.762 billion. If you do that for the midpoint valuation, this number plus this number is 7.3 billion. For the high valuation, it's this number plus this number is $9.9 billion. So that's quite easy, right? And then step number 7, which is actually already the last step of this first method, is to determine the fair price per share. Also, this is relatively easy, luckily for you and luckily for me. So what you do now is you're going to take this equity value, the fair equity value or the fair market cap, and you're going to divide that by the amount of outstanding shares. In the beginning of this video, we said that there are going to be 304.9 million shares outstanding for ChargePoint. So if we take these market caps, divide them by the amount of outstanding shares, you're going to arrive at these prices per share. So for the low end, $15.62. For the midpoint valuation, $24.06. For the high valuation, $32.49. So that is method number 1. Now we're ready for method number 2, which is going to be called the valuation benchmarking method. Sounds very fancy, not that fancy at all. So method number 2 is mostly used for companies that already have an established business. And yeah, many companies in the same sector have been around for a while, I would say. So this way you can compare the current state of the company that is going to be acquired by the SPAC with the current state of other companies in the sector. I've done this for BFT, which is the SPAC that is going to merge with Paysafe. And yeah, with regards to the first steps, I've already completed the first steps, so 1 to 3 of the beginning of this video. So I've already put in the correct price per share they started out with. I put in the correct amount of outstanding shares after the merger, and I put in the amount of net cash on their balance sheet. In this case, it's a negative number because they're going to have negative cash on their balance sheet, debt, instead of positive cash. And I've also put in the current price per share based on the number in TradingView over here, $17.02. So let's now start with step number 4, which is actually the first step of method number 2. So step number 4 is going to be to determine the fair enterprise value. This is very comparable to the first method where we also did this, but then we did it for the future. We're now going to look at the present fair enterprise value. We're going to need 2 numbers for this, just like method 1. We're going to need either a revenue number or an EBITDA number. Again, revenue is how much money they make. EBITDA is earnings before interest, taxes, depreciation, and amortization. And again, if you want to know more about that, go to the link in the description where you can read a little bit more about that. So we need either revenue or EBITDA, and we need a revenue or an EBITDA multiple. Let's talk about that. And now we're going to explain that with an example, not with ChargePoint, but with Paysafe. Paysafe, again, is the company that is going to be acquired by the SPAC BFT. So again, let's first take a look at the number revenue or EBITDA. In the example of Paysafe, we're going to look at the EBITDA of 2021, the year we're currently living in. And on the page over here in the investor presentation of Paysafe, they say that their EBITDA in 2021 is probably going to be $561 million. The organic EBITDA would be $501 million, but because they're going to merge with the SPAC and because they're going to be given additional money to increase their amount of growth, they expect that their EBITDA is going to grow as well from 501 million this year to 561 million this year. So that is the first number that we are going to use, okay? $561 million. We can actually put that in our Excel, or sorry, in our calculator, 561, 123, 123, okay? So now we already have our EBITDA. The next number we're going to need is an EBITDA multiple. And for that, we're going to compare the current multiple of Paysafe with other companies. How do we do that? This is very similar to the first method that we have been taking a look at. But what is exactly an EBITDA multiple, or an EV to EBITDA multiple, an enterprise value to EBITDA multiple? Let's give you a very brief example that has nothing to do with Paysafe. Let's say you have a company that is worth $1 billion with a B. Their EBITDA multiple, or sorry, their EBITDA in 2021 is 50 million, okay? The EV to EBITDA multiple, the enterprise value to EBITDA multiple would be 20 because the company is worth 1 billion. EBITDA is 50 million. 1 billion divided by 50 million is 20. So again, EV to EBITDA multiple is 20. Right here, we're looking at the EBITDA multiples of 2021. Here we can see companies that are very similar to Paysafe. Okay? So we're going to compare Paysafe's multiple of 2021 to other companies' multiples of 2021 as well. Okay? If it would actually say 2022, you would also need to take a look at the EBITDA of 2022. If 2023, then 2023. And it's very important, one thing here is you don't need to discount it back afterwards because you're looking at the same amount of years. If you remember ChargePoint, we looked at ChargePoint's multiple of 2026, but the comparables, the comparable companies rather, were of 2021. There's a discrepancy, but right here we're looking at Paysafe's 2021 numbers and comparable companies 2021 as well. Okay. So just like we did with ChargePoint, we're not going to be looking at just one EBITDA multiple, but we're going to create a range of multiples. And we're going to be looking at these 5 companies over here. So PayPal, Nuvei, Shift4, Repay, and Paya. And you can see the multiples over here. So for PayPal, 35x, Nuvei as well, Shift4 as well, Repay 27x, Paya 25x. On the low end, for Paya, the multiple is 25x. On the high end, for PayPal, Nuvei, Shift4, it is 35x. So these are the 2 ranges, the 2 multiples we're going to use to create a range of multiples, 25 to 35. Okay. So we now have our EBITDA of 2021, which, as we said in the beginning, a few minutes ago, is $561 million. We can multiply that by the multiples we just mentioned. So let's first do that with the low multiple of 25. So 561 million multiplied by 25 is a little bit more than $14 billion. $14 billion, which is also the number that I put over here in the Excel sheet. Okay. So that is the low multiple. Let's now do the same thing for the high multiple. So again, EBITDA of 2021 is 561 million multiplied by 35, the high multiple this time, is going to give you $19.6 billion. So that would mean that that is the high enterprise value, $19.635 billion, which is also the number that I put in the Excel sheet. So then we can also say, okay, so we have a low enterprise value of 14 billion, a high enterprise value of 19.6 billion. The midpoint enterprise value, which is simply the average of these 2 numbers we just have been taking a look at, is going to be 16.8 billion. Okay? So those are your fair enterprise values. Then step number 5 is going to be to determine the fair equity value. You remember, well, equity value is market cap. This is actually going to be the same step as step number 3 of method number 1. It's getting a little bit overwhelming maybe, but I hope you can still follow me. So this step is relatively easy. The only thing you need to do is to take the enterprise values you've just calculated, and you need to normally add the amount of net cash to arrive at a fair market cap. In the case of Paysafe, it's a little bit different because they don't have a positive amount of cash on their balance sheet after the merger, but they have a negative amount of cash on their balance sheet because they're going to have $1.8 billion in debt. So in this example, if you take the enterprise valuations, you subtract the amount of net cash on their balance sheet after the merger, you're going to arrive at these fair market caps. So for the low end, if you take 14 billion minus 1.8 billion, that leaves you with a fair market cap of 12.2 billion. For the midpoint is going to be 15 billion. For the high valuation is going to be $17.8 billion. So that's quite easy, right? Now, do keep one thing in mind. Again, I've already mentioned it before, but with this method, you don't need to discount it back just like in method number 1. Because right now we're looking at 2021 multiples, which are also compared with 2021 multiples of other companies. Okay, so that is something important to keep in your mind. And then the very last step of method number 2 is step number 6 to determine the fair price per share. This is also relatively easy and also a step we've done in method number 1. So what we need to do now is we need to take the fair equity values or the fair market caps, and we need to divide them by the amount of outstanding shares after the merger, which is, in this case of Paysafe, is going to be 719.5 million shares outstanding. So if you do that with these 3 market caps, you take these market caps, divide them by the amount of outstanding shares, you're going to arrive at these fair prices per share. So for the low end, you would arrive at a fair price per share of $16.98. For the midpoint valuation, $20.88. For the high valuation, $24.78. And that is method number 2. Okay, so those are the 2 methods that you can use to value SPACs. I'm now going to give you a few additional comments with regards to SPACs and with regards to SPAC valuations. These comments don't necessarily have to do with the SPAC valuations, but I do think these comments are very important to keep in mind. The first comment is going to be a disclaimer, and I say this in all my SPAC valuation videos. Don't trust me, verify me. It might sound strange, it might sound stupid, but it is true. You always need to check what I am doing, because the thing is, I'm not a financial expert, I'm not a financial advisor. I don't know 100% if these SPAC valuations are correct, if the method is actually correct. So that is something very important to keep in mind as well. The only thing that I try to do is to learn as much as possible myself and to transmit the information to other people out there just like you watching right now. But again, I could be completely wrong with these valuations. The next comment is with regards to valuations being just a tool. Because the thing is, I see investing a little bit as a person with a toolbox. Within that toolbox, you've got multiple tools. You've got valuation analysis, just like we've done right now in this video. You've got news analysis, fundamental analysis, technical analysis, just the ability to see in the future, to think a little bit about what could happen in the future. So these are all tools that are very useful for an investor. And again, valuation is just one tool. It's not the only thing that is going to move price action in the future, okay? So keep in mind that this is just one tool. You need to use all the tools that you have in your toolbox. Then with regards to assumptions, and I say this in all these SPAC valuation videos as well, you're looking at assumptions. Because the thing is, investor presentations are very useful, but they are a little bit like marketing. They're trying to be very attractive. They're trying to lure you to the SPAC, to the stock actually that they're selling to you, right? The thing is, it's like marketing. Because look at it this way. If a company is worth $2 billion, for example, and in the investor presentation, they make the case that the company is actually worth $2 billion, investors are probably not going to be very hyped about that company. But if you have a company that is worth $4 billion, and in the investor presentation they say, well, if you now invest based on this share price right now, is worth only $2 billion. So if you invest right now, you could actually make double your money. You can double your money, 100% your money, if you just start investing right now, because now it's just at 2 billion, but it's going to be, or it's actually worth $4 billion. So keep that in mind as well, that SPACs are trying to make the offer seem very attractive to you. Also keep in mind that the revenue and the EBITDA numbers are usually predictions as well, especially if they're looking in the future, just like ChargePoint 2026. No one is going to know exactly what is going to happen in 2026, of course. So these are all predictions. These could be completely lower, higher, the same. We don't know, okay? So that is something you need to keep in mind as well. The SPAC is probably going to make them look high, but you're not sure if that's actually going to be attainable. And then the multiples are also assumptions, because we have been taking a look at a comparison between several similar companies. In the example of PaySafe, for example, we try to compare them with PayPal, Nuvei, and other companies out there. But the thing is, these multiples are just, multiples of those companies. It doesn't necessarily mean that PaySafe should have those same multiples as well. Maybe PaySafe is better than those other companies. Maybe PaySafe is worse compared to those other companies. So maybe the multiple should be higher or lower, depending on how good or how bad they are compared to their companies, the similar companies out there. Another comment I want to make is a comment about warrants. Warrants are options. Now, I don't know enough about warrants to make a very big video about warrants, but you need to take into account that there are warrants outstanding, and usually these warrants are not included in the amount of outstanding shares in the investor presentation. At some point, these warrants are going to be exercised. That means that those warrants are going to be converted into normal shares, outstanding shares, and that means that the amount of outstanding shares is going to go up, but also the cash position of a company is going to go up. In my valuations, I usually don't keep these warrants in mind. I usually don't take them into account, but maybe I should actually do that, because at some point they are, of course, going to be outstanding. They are going to be exercised at some point in time. So maybe you want to decide to include the warrants in the amount of outstanding shares, but then also keep in mind that you need to include the cash from those warrants in your calculation as well. Then earnout shares. What are earnout shares? Well, these are shares that are going to be issued additionally when a stock after the merger is going to be trading above a certain price level during a certain time period. Sounds a little bit difficult. I'm not going to explain too much about this, but basically means that you're going to have more shares outstanding after a certain moment because the price is above a certain threshold. You can also decide to include these earnout shares in your calculation as well, just like warrants. Currently, I'm not doing that because currently I'm just following the investor presentation. And you also don't know for sure if those earnout shares are going to be issued because you're not sure that the price is actually going to be above the threshold in the future. Then a comment with regards to the market cap. And this is a mistake that I see quite a lot of beginning investors make. What they do is they look at the market cap of a SPAC instead of the pro forma market cap, so all of the shares outstanding, etc., just like we saw in this video. Sometimes people say ChargePoint is more expensive compared to Blink because ChargePoint, or SBE, because they're only looking at SBE, has a higher market cap compared to Blink. They're not looking at the pro forma market cap, which is usually way higher, usually about like 5 to 10 times as high compared to the SPAC. So always look at the pro forma market cap and not just the market cap of the SPAC itself. And there are also people sometimes saying if they see a SPAC trading at $40 per share and another SPAC at $30 per share, that the SPAC of $40 per share is more expensive than the SPAC of $30 per share. It seems obvious that it actually is, but it's not necessarily true always. Because imagine there is a SPAC of $40 per share, but it has 100 million shares outstanding. Another SPAC has a share price of $30 per share, but it has 200 million shares outstanding. So that means that the pro forma market cap of the second company of $30 per share, but 200 million shares outstanding, has a higher market cap compared to the SPAC, which is trading at $40 per share. So always look at the pro forma market cap, not just the market cap of the SPAC, and also not at the price per share. So this has been a very, very long video. I'm aware of that, but I wanted to be relatively detailed compared to the other videos so that I can actually refer people to this video if they don't understand a certain thing. I think this Sunday, because usually I do live streams on Sunday, I'm going to do something like a masterclass for SPAC valuations. What that means is I'm going to be live on YouTube at 12 o'clock Eastern time, which is 6 o'clock European time. And then I'm going to go through these methods, and then you're going to be able to ask me questions about these methods as well. Okay, I think those should be the most important things to take into account when you are valuing a SPAC. Now, this took a lot of time to prepare. It took also a lot of time to make this video. So if you liked the video, if you thought this was valuable, please consider sharing this video with your friends who are also investing in SPACs. If you do have more questions about SPAC valuations, please let me know in the comments or please join the live stream on Sunday. And with that being said, thank you very, very much for taking the time to watch this video, and I hope to see you in the next one. Bye-bye. Oh my god, that was insane. I need a Red Bull.